morning, everybody. This is Fred Meissner with the Fred Report Technical Market Conference Call for March 17th, 2011. Want to welcome everybody to the call. I hear a couple of people are still beeping in. Obviously, we're having a little bit more fun than we have lately in terms of volatility. The important thing to remember is, first of all, whatever is happening with the volatility in the news and the reasons, the market has basically gone down to the support areas of 126 to 124 that we've been looking for over the past month, and seems to be holding and supporting in these areas, albeit with some volatility. The important lesson for people to learn on about what's going on here is something we've been talking about before, which is the sentiment indicators. When you don't have a rise in bearish sentiment on bad news, oftentimes the market suddenly becomes a lot more volatile, especially towards the end of a move. And with that in mind, we want to note the put-call number individually for yesterday was finally up to where we saw some of the individual put-call numbers around the 1st of July last year at that bottom. But Investors Intelligence percent bears, it was only 22% yesterday, and the moving average that I keep of that is only around 20%. And at really big, giant intermediate bottoms like we had last July, those numbers were in the 50s. We actually had more bears than bulls at the bottom. So from that standpoint, this is not a sentiment intermediate bottom, although we have come down to support. And while I do think we can rally from here like we've been expecting us to do for expiration week, in other words, we can be up today and possibly even up tomorrow, we still have the problem of overbought weekly indicators and some overbought monthly indicators at the end of March. So we will reevaluate everything at the end of March. Given the fact that this is expiration week, you're seeing a little bit more volatility perhaps, but the important thing to remember as we fly around here and go up and down and up and down, despite this news, we're actually doing what we should have done for a correction. And so I actually have to be a little bit positive here, very short term, while realizing that we could have some issues with the weekly numbers. With that in mind, the stock market is basically fine, and let's see what happens. Now, what we're going to look at now is the T-bonds, because that's one of the other indications of what we've had going on here over the past few weeks. And T-bonds have hit their 94.50 target area. If they get above 95 closing basis, you're going to see a move up to 98 and to fill that gap 98, 99. But actually bonds have fulfilled their upside, and it took them long enough to do it, and it was hard enough to do it, that this might be it for the bonds, and this might be it for some of this turmoil. So I would be a little bit cautious here. Those of you who emailed me that they sold their bonds yesterday at 94.50, good on you. That's what I would have probably done too. And, we got to take a look at this bond market and say, again, we think that rates can fall a little bit into summer, but they're going to end up higher at the end of the year. We are still sticking with our idea that bonds could be, or rather the market and everything is going to have a good second half of the year, and that the second half is going to be better than the first half of the year. In terms of commodities, gold, oil, all of that, gold still is not down enough as far as the stochastics are concerned. I'm still looking at entering gold between 135 and 132 over the next month or so for a strong summer rally, and the same thing with oil, the USO. And I also mentioned we've got that really nice gap in USO down at the 3680 area that could fill as some of these fears abate and some of these Middle Eastern tensions go away. But I'm looking for a strong summer rally here. If I'm in oil, I would stay in. If I were looking to add to it, I would wait to see if we can get the stochastics down below and above 20, which is what you normally see at this time of year as the weather warms up a little bit. And I mentioned to a couple of people at the beginning of the call, I am in sunny Arizona. It's going to be 85 today. So we're definitely seeing warming. Atlanta's going to be in the 80s this weekend. Oil should fall off seasonally, and the commodities in general should do that as well. Turning to some individual stocks, we've had some questions on IBM, which came down on a downgrade. The stock actually looks good. There's been a gap in IBM, sort of in this 150 to 153 area back in January. The stock looks to be filling that gap, but basically, other than that, is still an attractive stock on a relative strength basis. DuPont, which we mentioned the other day, that stock has come down and held support and is actually rallying. I think that stock can make it back to all-time highs. One question we've had on another big blue chip name, General Electric. You'll notice that with all this news, all it's managed to do is come down and fill its gap as well. And we didn't have a lot of individual stock questions because we were traveling yesterday. I presume some of you guys on the call have questions. That was.